Hello everyone, this is Bill Hall for Money and Markets. It's Wednesday, September 24th, and I'm pleased to bring you this market insight. As an investor, there's one thing, yes, one thing you should be focused on right now that will have the most effect on your investment returns and your portfolio, and that's the actions of the Federal Reserve. That's right, the actions of the Federal Reserve will have the primary impact on your portfolio and the returns for the remainder of the year. That's because it's the Fed's easy money policies and low interest rate policies that are driving the stock market higher. Take a look at our first slide and you'll see exactly what I mean. This funny looking chart that sort of looks a bit like dominoes. In financial circles, it's known as the blue dot chart. And what it tells us is the projection of future interest rates by each of the Federal Open Market Committee members. So each blue dot on this chart represents what each member of the Federal Open Market Committee believes the federal funds rate should be at a specific point in time. For example, looking all the way to the left of the chart, we believe that the Federal Reserve members believe that interest rates should stay low in 2014. We can see this because we see all of the blue dots aligning at the bottom of the chart in the 2014 category. That's except for one member, as we can see in the 2014 column, that believes interest rates should be substantially higher than they are currently. But overall, the blue dot category for 2014 shows us that all the members except for one believe that interest rates should stay low. Now looking across the chart from left to right, we see that in columns for the 2015 column, the 2016 column, the 2017 column, and the longer view, we see that the Federal Open Market Committee members think that rates should drift up. Of course, that's no surprise. The question is how quickly they are going to rise. And in the 2015, 2016, and 2017 columns, you see a lot of dispersion for these blue dots that we don't see in 2014 and that we don't see in the longer run. So 2015, 2016, 2017 shows that there's a lot of disagreement among FOMC members about where interest rates should be in those years. Again, this is important to stock market investors, and it's really important to stock market investors because it's these low interest rates that are supporting the lofty valuations in the market. Now let's look at our second slide, and what you'll see is a chart that reflects where the same FOMC members have projected economic growth will be looking forward. The detail of this chart is not so important right now. You can take some time and study it on your own. The big point here is that the FOMC members, the same people that are setting interest rate policies, have been overly optimistic in terms of their future anticipated growth rate of the overall economy, and they've had to mark that growth rate down continually, meaning over and over again they've overshot on what they thought that the U.S. economy was going to grow, and they've had to mark that rate down. Why is this important, you may be asking? It's important because if the growth rates of the economy do not come through at the level at which the FOMC or the Fed have projected, then they will be forced to keep interest rates low. So recent history says that the FOMC is overly optimistic, meaning they think that the economy is going to grow at a faster rate. Therefore, they think they can raise rates faster in a growing economy. In essence, what we've had is a slow growth economy. Therefore, they have not been able to raise rates as rapidly as they thought. So let's go back to our first chart again. And the primary factor, again, influencing your portfolio returns and stock market returns going forward is what happens in terms of this dot chart. Are the dots going to line up the way the Fed thinks, or are we going to undershoot as we have in the recent past? My view is that we will undershoot, and that will be good for stocks going forward. So all in all, it's a connect the dots game. If those dots connect at a lower level than anticipated, and that's what I'm thinking is going to happen, then stocks drift higher for the year. This is Bill Hall for Money and Markets, and I look forward to speaking with you again next week.